Well, good afternoon, investors, and welcome to the July 9th National Hot Dog Week edition of Bull Sessions. I guess I should have put together the fact that they have the hot dog eating contests in the advent of National Hot Dog Week, but that one got by me, Ken. So good afternoon, Ken.
Good afternoon. I know that Matt is traveling up in Alaska, so he won't be with us this week. And you said Kim was working on negotiating with some people about her deck, so it's just the two of us right now. So we'll have to handle it, and maybe we can make strange voices if we needed more talkers. Okay.
Well, I went back to our Tequanimon Falls picture there and substituted in some hot dogs for our
All
fritters.
right.
And trust me, everybody out there, we do not need the stocking caps in Michigan right now. It's pretty scorchy. And of course, we date stamp everything with an acknowledgement of the fact that they're playing tennis on the grass in London and they're playing soccer on the grass both in the United States and in Germany. And if you love soccer, my gosh, you could have watched wall-to-wall soccer for the last couple of weeks and some excellent contests. So good stuff. And actually, Portillo's is there in honor of National Hot Dog Week. We'll spend a moment with that in a second. But what's interesting about the graphic on the right, in the most recent game for Argentina, they went to penalty kicks to decide the match at the end, Ken. And Messi actually missed a penalty kick for the first time in 10 years. And that picture is actually the kick that he missed 10 years ago, where it goes over the crossbar. So high drama. I actually don't. I would prefer that they would just go ahead and play in overtime. Maybe sit the goalies down and turn it into a free for all. But the penalty kicks are the way they settle things. And maybe we'll go to a penalty kick format on our stock selection. Who knows?
My wife has become intrigued with this soccer stuff, and we've been watching hockey, and we actually watched the last 50 or 60 minutes of this match, including the overtime period before the penalty kick. So
There
I
you
saw
go.
him miss there. Yeah, Argentina still won, but I saw him miss. So
Well, all of our grandsons were sporting their Messi shirts when they went down to the Detroit Soccer Club game the other night. So soccer is big in our family right now. All right, here's our reminder, our weekly reminder that Portillo's is not a sponsor of the session, although they should be. And in honor of National Hot Dog Week, they are requesting that you send in pictures of your pet, and they've got some freebies that they're giving away, and then offer to sell you a leash for your dog and all that kind of stuff. The stock price has recovered a little bit. It's now time for the stock price to head north and turn me back into the genius that I was 4 months ago.
just did you start talking about this? At what point in the decline did you start talking about this, Mark? Okay.
You need a longer term chart and higher prices. I think my cost basis is supposed to be 18 or 16 or something like that.
All right. That's enough. I won't give you any more. Okay.
Just it just further antagonizes you into pointing out that we can affect stock prices just by talking about them. All right, here's our standard disclaimer, the boilerplate
I just have
is.
to learn how to short things. That's all, Mark.
Oh, we could have a discussion on shorting here pretty soon too. Hey, no investment recommendation is intended by anything that we do here. This is an educational demonstration where we explore the discovery and analysis of stocks and build by design portfolios that are basically designed to succeed. And so we're illustrating and demonstrating the philosophies, methods, and techniques of the modern investment club movement that, as a champion by one George Nicholson, we were running around in his neighborhood, by the way, as we went to that soccer game down on the east side of Detroit. And that was almost 80 years ago that he became involved in the modern investment club movement. That became the National Association of Investors, now known as Better Investing. So that we're basically leaning on 8 decades of experience and demonstrations of successful investing. That's what we're attempting to share here. Please do your own homework when it comes to the analysis of any particular potential investment opportunity before you make your own decision. If we own something in our own portfolios, we will try to disclose it. I do, as I just disclosed, own some Portillo stock, so looking for some price support. And again, we assume that you can make your own decisions about the things that are most helpful and supportive in your investing related efforts. If you would like copies of the slides, if you have follow-up or private questions you would like to ask, our two email addresses are down there at the bottom of the page, and we'd be happy to field them and try to get back every once in a while. Actually, fairly frequently, we will actually take one of those questions and air it out here at Bull Sessions. Anything else you would like to add, sir?
No, I think that covers it. Let's get into the meat of the program here.
All right. Here's our groundhog update. Jim Gallagher and his sandy feet are still in the lead. I think it's actually widened. So our Florida native is doing pretty well. Everybody seems to be cooking pretty well. About a third of our participants are beating the market since Groundhog Day. Keep that number in mind as we share some statistics about how challenging that is over the long term here in a few slides. But alas, Ken, I can't find my name on the list, so I'm disinterested. But I will point out that Sean Mace has climbed onto the leaderboard at number 42. So
all right,
good stuff, Sean.
And we hit another high today, Mark, in this particular slide. I've been keeping records of how many clubs are on the top, whatever we put on the slide, and this is up to 11 now, and that's a new high. We have never in this year had 11 clubs in the top 42, so that's good.
There's a number that are just below the list, so it could get very interesting here. It's fascinating to see the groups perform so well, but again, that's what our community is all about. But anybody else really come up dramatically? Bill Warner came up from 56th to 28th, I see. That is Ty Hughes Club. They're at number 34, Moose Pond Investors.
Is Jerry Warner a relative of Bill Warner, do you know?
Don't know.
Down in 41, because he went up quite a few spots also, as did Phil McPherson.
Mm-hmm. Anyhow, the average return is about 8%, which is awesome. I wish my 5.6% was doing a little bit better, but it's better than minus 5.6%. And as we will be covering here in a few minutes, the Wilshire 5000 again has gone up to almost 12% since Groundhog Day, a gain of 12%. The value line arithmetic average, however, is stuck at 0.4 or 4.8%, and that gap just continues to widen, and it's weird. And we'll talk a little bit more about that. The monkey is back into the top 100, but comfortably down the list, and Kathy Wood continues to leave room for opportunity to improve. And by the way, go ahead.
Bill says that Jerry's not a relative, and this is a real long shot, Bill, but were you a Delt at a small college in Southern Ohio? I'll wait for an answer and see.
You have a colleague, potential colleague on the list. And what was the other thing I was going to point out? Oh, that's not a Portillo's hot dog. That's just expanding our hot dog experience. That happens to be an Omaha steak hot dog in the picture.
We're going to know much more about hot dogs than anybody wants to, Mark, okay?
I'll stop hot dogging and talk about the market. Here's our measure of the stock market. We do typically track the characterization of the stock market, not by the Dow, not by the Wilshire, not by the S&P 500, but by the value line arithmetic average. It's closer to the style of investing that we do, that being all of the above, small, medium, and large companies. And we like to track the forecast provided by Value Line versus our collective forecast for our universe coverage. And again, the average stock is checking in right around 10%. We have had a few lazy days here in early July, and that green bar on the right represents the stock market has come down just a tiny bit of slippage from early in the month. Now the Wilshire 5000 is actually still clicking off new highs, and the S&P 500 virtually every day. So just more evidence of that, the challenging nature of some of this stuff. Any thoughts, sir?
No thoughts. The graph speaks for itself anymore.
Well, I'm going to go right to this one then. I did a little bit of cleanup. We talked about this one last week. We've been putting this out for years. In fact, the graph itself was done by the Wall Street Journal for an article a few years ago. And back in that time frame, this would be 8 to 10 years ago, we had noticed that it was more typical for the value line low total return forecast to resemble actual performance. That has changed over the last several years. And what we did is we went back in and substituted out, just like a soccer game, we substituted out the value line low total return forecast and sent in the value line median appreciation projection. That's Mark Holbert's favorite, by the way, the VLMAP. And that what you're looking at here now is actually a more straightforward characterization of value line forecasting versus what actually has come to pass in the stock market. And you don't have to squint quite as hard to see that this is a pretty reliable resource, and it speaks to the effectiveness of the value line research product, and I think the enthusiastic deployment of stock research in our community that includes all of the clubs nationally. But you like this one better, Ken, right?
I like this one a lot, Mark. I like the fact that it kind of bears out what I've always been thinking for the last 4 or 5 years, that the low might have been a little bit too low for a lot of the stocks I look at. So I'm going to train myself now I don't think you can get this number directly off the sheet. I think you got to do a little tiny bit of arithmetic to get it, but it's just adding two numbers, dividing by 2, so it shouldn't be that hard.
Yeah, and I think it was Nick DiVirgilio that pointed out that it was a little bit confusing out on the end. This now matches up pretty well with this chart. Again, that 10% now is what you're basically looking at out here, basically 4 years from now. So it begins to make a whole lot more sense. So again, what you're looking at is what I believe is the answer to the question, how well does the method work? And when I talk about the method, I'm talking about stock selection guide driven analysis of companies. You were going to say something, Ken.
No, I'm just going to say that, Nick, you're unmuted. If you want to make a comment, go ahead.
Yes, thank you very much. So if I'm reading the red line correctly, as of December 31st of this year, it seems like the market will continue to rally. But then after that, again, the red line goes up, which means the return goes up, which means that there's a potential for a downturn in the market. Is that a correct assessment? Am I reading the red line correctly?
Yeah, you're kind of backing into it from the way I think of it, but you're correct. I mean, I think, yeah, if prices go down, returns go up. So yeah,
Right.
that is right. I mean, you're basically looking at the aftermath of the recovery from COVID. Again, think back, it was 4 years ago. So
Yeah.
that disruption on where the green ends is you're talking about coming out of the teeth of COVID and 4 years later. And then, as we'll show here in a couple slides, good segue, Nick. There was some pretty dramatic price action in all categories of stocks, but we'll feel the effect of that as things do tame down here over the next year or so. So
Well,
I hope
yeah.
this.
Yeah, I'm sorry. I'm just again, I'm focusing on the red line. Maybe that's the wrong thing to focus on. But
I hope this comment doesn't go sideways, okay? But I'm going to try to make the point that there's not necessarily a drop in prices as the red line is, as some people might interpret that red line. what the red line is showing us is that the appreciation is slowing, but it's nowhere near zero. It'd have to get down to zero for there to be an actual drop in overall market prices. We're
Right.
looking for a slowing of growth, a slowing of appreciation growth. And instead of growing 12% for a couple years, maybe it's going to grow around 10%, which, by the way, is long-term average. And so it doesn't necessarily portend for the market as a whole any really strong negative negative vibes. This is still showing a healthily growing market, and the worst numbers from now until we go forward we're experiencing right now, and 5 years now, 3 to 5 years from now, we're looking at what Value Line is predicting at around 10% median growth, and that's pretty darn good. That's what the median growth has been for probably since the early 40s, if not earlier than that even.
Right. Well, where the red line peaks above 15%, that's kind of the area that I'm interested in. I know that might be kind of short term, but wouldn't that imply that when the projections, when the projected returns go up, that the stock market would necessarily go down?
No.
Okay.
Not necessarily.
It just implies that the growth is going to slow. This red line is showing growth everywhere.
Yeah.
No, I know that, but I'm talking about like beyond 2024, where it peaks around.
Right, I understand what you're saying, but not to get real mathy on you, but this is not a first derivative graph. This is a second derivative graph talking about growth, and growth is just slowing. And when growth slows, you don't necessarily have to have stock prices that are in decline.
Okay, all right, thank you.
And probably the way that most people need to look at it is take a look at the point on the farthest right on the green shaded area. Again, every single one of these points left of this point right here is a comparison of what was the forecast 4 years ago and what were the actual returns. So 4 years ago, the return forecast was 12.5%. What actually happened between June 2020 and 2024 is the actual return came in at 15. Those are basically the same number in the statistical view of the universe. So that's all it's saying, is that the forecast matched fairly closely with what actually happened. So it's a fascinating chart, and with a couple of major excursions.
And when you see those white spaces beneath those red dots, most of them are black swan incidents that could not have been predicted 4 years prior to when things happened. There's actual negative growth right down there. And with negative growth, you might actually see stock prices declining. And we actually saw that happen in 2008. We saw portfolios declining for the first time in years. People with established portfolios lost money in the entire portfolio. We saw it again during COVID, not for nearly as long a period, thank goodness, but we saw it happen. So when those green lines actually fall beneath the zero line, that's when you're seeing contraction in the stock market. But those periods of contraction to the point of declining market are kind of rare. They're few and far between.
Yeah, and then of course here's the other way to look at it. Back during that period when it was really nasty, stocks were taking a real beating at the barbershop. At that time frame, if you believed that the fundamentals would be intact, the belief at the time, and it's basically the engine that makes our community work, is that if you believe that the fundamentals are intact, the long-term sales growth trend, the profitability of the company, and PE ratios, you can expect these type of returns. And we had one of those back up the truck moments back in that time frame, and then also with COVID. If you believed that fundamentals were going to be okay, you believed that forecast and you invested regularly, if not more assertively, during those timeframes. So again, kind of an interesting thing to look at. We'll spend a little more time with it as we need to. I also did a little cleanup on this chart, Ken. I had actually shortchanged the universe a tiny bit, but again, it makes the point that our view of the universe is over here. The stocks that are in the value line standard edition, when we look at them, we see a couple hundred that are in the buy zone. The vast majority of them are holds, and there's a few sells. The rhinos, when they look at that same universe of stocks, and I had shortchanged the universe a little bit, so all these numbers are caught up. There's a whole lot of buys here, and all I did to form these was to combine the strong buys and the buys and the strong sells and the sells into three classifications. So it's a dramatically different view, and it raises a healthier dose of skepticism over the validity of analyst ratings. As my dear friends on the old Better Investing Stock Selection and Securities Review Committee would point out, you might want to ignore the ratings and pay more attention to the stuff in their databases and the actual numbers. Ignore the headlines and look at the rest of their work, was always their message to us. So good, clean fun. Just thought I'd clean those up for us, Ken. All right, coming back to this one, Ken, it's one of your favorite subjects, so I threw this one in here courtesy of Barry Ritholtz. I think it says it better than I did, and it shows exactly the number that you wanted to over more than 50 years. That's almost what? It goes back 70 years.
Yep, long time, almost 80. 77. No, I'm doing my arithmetic terribly. Yeah, you're right, Mark. Okay.
But over that time frame, at a 3% rate of inflation, you're talking about a 10% return. The real return being 7% after correcting for inflation. So that's all this.
Yeah, it's a wonderful graph to display to people when you're trying to convince them that the risk is worth the reward, as long as you're a little bit careful and know a little tiny bit about what you're doing. Even if you're going to stick with index investing, I would imagine that a lot of these numbers are based on the indexes rather than on individuals. Am I right, Mark?
I don't know exactly what they are. I'm guessing that the one would be the Wilshire 5000 in some way, corrected for inflation.
Yeah, some
And
kind
then
of a total market index, right?
a total
Yep.
index. Yep. So just good reinforcement. And then here's another slide that we have not looked at lately that I just love. In fact, I'm going to start doing this for my industry studies, Ken. The characterization of operating margins versus net margins, and just the general long-term trends. They still look pretty good. They are still calling for numbers up in this range, out for the 4-year forecast from Value Line. So pretty powerful picture, but again, it does show a very macro level the relationship between operating margins and net margins, which basically form the earnings per share
I
estimates.
think a great reminder slide, Mark, for us to do in a bull in the next couple of weeks might be to show how these two margins are tied to pre-tax profit margin, which is the profit margin that a lot of folks get in their raw data. So we could, but we know that the arithmetic is tied very easily together, and it's fairly simple to go from one to the other if you understand how the tax rate fits in. So maybe we could put in a slide that shows that transition so that people can easily talk about all these margins in the same general breath without worrying that they're mixing them up.
Okay, I just added to my list of things to do. I will add a magenta pre-tax profit line and display this. Might not be next week, Ken, but at some point in the future.
Well, there's no rush on anything like this. So.
All right.
That's the beauty of being a volunteer, Mark. Okay.
And here is a response that I got a number of pieces of email. They were divided exactly 50% attaboys to 50% not attaboys. And I just wanted to make the point that my observation last week continues to be, in my opinion, my personal opinion, quite valid. And that when you watch the nightly news or you watch these people reporting on polling results, they are virtually meaningless when they talk about the popular vote. After the debate, the lead widened a little bit for one of the candidates, and it appears to be shrinking back a little bit, believe it or not, despite what you read. But the real thing that matters is the Electoral College. And again, don't shoot me. These are actually based on a state-by-state rundown of current state estimates, courtesy of Nate Silver at 538, now part of ABC News. What is interesting is you'll never see these numbers here reported in the news. They always want to talk about these 42 to 41, or they're talking about 4 or 6 point spreads. And again, keep in mind that it's still early. The election is not today. There are still at least 10% in virtually every state out there undecided. So there's a lot to be done. But as of right now, one of the candidates has a fairly sizable lead in the Electoral College. Again, not my prediction, somebody else's. So
Mark, if I were in my 30s or 40s, I'd be paying very special attention to what's happening in Maine and Nebraska, because if that movement continues and moves into more and more and more states, that's going to change the Electoral College map as we know it. I mean, for most of history, it's been based on a winner-take-all kind of a reward. If you win the California vote by one vote, no matter which candidate wins, they get all of the Electoral College votes. But in Maine and Alaska, their legislatures, which have complete control over how those electors will vote, their electors have decided to split these votes. They are still going to honor congressional districts, and they're still going to honor a couple of at-large votes based on the fact that there's senators as well as representatives. Maine, for example, only has 2 congressional districts, even though it gets 4 votes. So I might be saying that wrong.
No,
I'm
you're
going to
right.
take that back. But I'm going to take that back. I think I've made an error, but we'll leave that for the political scientists to talk to me about. But the point is that if we start dividing these by congressional districts, we have the opportunity to come out with a completely different map. In some cases, with the results being nearly the same, but in a lot of cases, with the results being very different from what we're used to.
Yeah, and Ken and I both reside in one of the biggest battleground states in the country, and that means our commercials are ad nauseum for both candidates. And I just keep my TV off for the most part. But yeah, if you had that type of vote by congressional district, it would change things quite a bit, because you can swing the entire state with a couple of key areas. The other thing that I did want to point out, what does this have to do with investing? Very little, except that not me, but Wall Street. In fact, Josh Brown just did an excellent summary of, what Wall Street is expecting and how they would change, how they would operate. So, like, for example, if you think that former President Trump is going to win and come in and make certain changes to recommended changes to tax laws and regulations and that sort of thing, you might even want to go back and see what industries thrived from 2016 through 2019. If you believe it's going to go the other way, perhaps you do something differently and see what has seemed to thrive over the last few years. But Wall Street is already beginning to make that shift in some of their expectations. That doesn't mean they're right, but some of the activity that you see happening on Wall Street now is based on the perceived or expected outcome of that election. Anything else, Ken, to try to avoid getting in any trouble with the audience?
Enough political talk. Let's move on to stocks. Okay, let's talk stocks.
Let's get back to defensible numbers. All right, here's our performance perspectives over the last 10 years, going back to the end of June 2014. Again, our favorite companies up at the top there do fall into our Manifest 40, most widely followed companies by our subscribers. The indices are down at the bottom. You can see that Cognizant and CVS Health are the only two that have been disappointing. You can also see that the small and mid caps have had a rough go, and we're going to talk about that a little bit. Anything else?
I think it's wonderful, and a couple of people that I've been watching on television have made this point in the last 6 months, and that's that there is an index that's been behaving like a stock, and that's the triple Qs, and that has to do with the fact that the triple Qs contain what they've been calling the Magnificent Seven, besides another 93 stocks, but that 7 are in there.
Yep.
But a person invested in the triple Qs is making a very handsome return. A 7% relative return, 6.9, is nothing to be sneezed at over the last 10 years. And it's so easy to do that. It was so easy to do that. We'll see if that continues. We don't know if it'll continue or not, but we'll see.
Yeah, I definitely do track it, especially watching it using the relative strength index, and actually made a killing on it a couple years ago, getting in at a low, and switching back to individual stocks after it had quite a run up for me. So can be done. Here's just a graphical representation of that same information. Here is the reality again, that over the last 10 years, the average rhino checks in at the number that you see there, closer to 9%. The value line arithmetic average that we talked about earlier has been lagging the Wilshire 5000 by what you see right here over the last 10 years. Much of that difference coming here lately. The Manifest 40 is basically held back by a large company bias. Many of the companies in the Manifest 40 are going to be headliner type companies, even though we do have more off the radar companies than usual. Speaking of off the radar, best small companies are cooking right now.
Mark, could the Manifest 40 be held back also by the idea that there are 40 stocks in that particular selection, and when you get upwards into into 40, 50, 60, 70, 100, 500, 5,000 stocks, you become more and more like the market, and you would expect to come closer and closer to where the market average is and to where the average rhino is.
I think you're 100% correct. I think that the presence of the Walgreens and the Pfizers and some of those type of companies are actually holding it back a little bit right now. And those companies are not in, obviously, the best small companies. They're not in 10 Cup. And the roundtables have been smoking pretty good here over the last 10 years. So yeah, and then the BI Top 100 is vulnerable to the same bias and the large company weighting. Even though you've got a bunch of the Magnificent 6 or 7 in there, it doesn't offset the impact of a lot of the slower growing companies.
One of our audience members, our research friend Len Douglas out down there in Grosse Ile, is telling us that VGT, XLK, and IY Ware acts like the triple Q, but gives you even 10 to 20% more return. So there are other indexes out there that you could look at if you're looking for index investing. There are other indexes out there similar to the triple Q that give you some really great returns. There's that XLK that Len had in his post just now. That's the second one, and there's the VGT in 4th place. So these are all readily available either as a mutual fund or as an exchange traded fund. I think that Mark's even coded them so that the ones that start out of M:, those are still traditional mutual funds.
Yes.
And then the rest of them are exchange traded funds.
So you can see it's not just a QQQ party, as Len has pointed out. There's been a number of technology-rich sector funds or ETFs that have done quite well. And yeah, good stuff. So here is part of that issue that we have been talking about for, it seems like a couple of years now, Ken. Seems like a couple of years because it has been a couple of years. The Russell 2000 is shown in red here is typically the small cap companies. Again, we don't do cap, but we do small companies growth. But as you look back at this chart over the last 20 years, I think Len Douglas actually sent this to me, or at least a form of this chart. And you look back over 20 years and you have a hard time finding a point where the blue has actually outperformed the red long enough to catch up, with the exception of COVID here and the 2008-2009 financial challenge that we had 14, 15 years ago. And lo and behold, we're actually in one of those moments again. This perfectly represents, first of all, Ken, why our 8-year-long winning streak went away.
Oh, absolutely,
in the
Mark.
best small companies, and
Yeah.
we're back in that realm of just generally the red has led the blue, and we expect the red to continue to lead the blue going forward. The blue being the S&P 500. So that's there.
What bothers me, Mark, is that more and more I'm hearing people on the Talking Heads channels telling me that this is going to be happening, and the more I hear people telling me it's going to be happening, the less confidence I have in that it's going to be happening. So, but an awful lot of the rhinos are thinking that the time for small caps is coming very soon.
Yeah, that is troubling because that just probably delays the onset of it.
I agree. I agree.
We need more loathing. You know, Hugh McManus talked about loathing again yesterday with me, and more loathing is what's needed to kickstart that fire. Again, these are the companies that have the mutual funds and exchange traded funds that have outperformed the market. Again, about 25%. We're going to look at the numbers here in a minute. The thing that these have in common, and we just keep repeating this, it's part of the design premise behind Buttonwood, a little more growth in the portfolio. For years, we've been talking 11 to 12%. This suggests that maybe that ought to be 13 to 14 now, Ken, and that's sort of why we have leaned on this assertive demonstration for Buttonwood. In fact, I'll make another graph in addition to your magenta graph, just showing that growth and return really do run together over the long term.
We have a comment from Marie Frankmark, and Marie suggests that another very interesting graph might be to take a look at the historic time when interest rates were higher, when they were in the 5, 6, 7, 8% range or more, and see what was happening to the small and the larger stocks during those higher interest rate times. I mean, we've been in this higher interest rate environment now for, I know it seems like forever, but it's basically been just for about a year, maybe a little bit over a year. And things will change as interest rates change significantly, and they have.
Yeah, and we've also talked about it in the past. Some of that is how do I say this diplomatically other than wrong? A lot of the companies out there, including some of the smaller companies, have very well managed debt portfolios. And we pointed out just a couple of years ago that a lot of the rhinos were forecasting all this doom and gloom with higher interest rates. And you could sit back and look, well, a lot of these were notes at very low interest rates that expired many years from now. And again, the operational threat to these companies was not real. And maybe there's some of that cooked into the small company market also.
I'm asking a question out loud to our audience, especially to the 3 or 4 folks that really dig into making charts and graphs. And I'm just wondering, can we get a really decent graph of average interest rates over the last 50, 60 years? My gut says we can. I'm not certain I want to go looking for it, but I'm pretty sure we can find it. And if somebody has something like that available, send it to Mark, because I think it would be an interesting graph to overlay on some of these other growth graphs of the different size stocks that we're looking at.
Absolutely. And again, it just underscores the fact that if your company is well managed when it comes to capital structure, capital strategy, changes in interest rates are probably going to be less of a problem. Nowhere is that more apparent or transparent than in the regional banking thing that happened a year ago. They were not being prudent, the ones that actually got caught in that quagmire. All right, here's an article that I believe Matt shared from Jason Zweig at the Wall Street Journal. Jason's an excellent writer, and he just basically talks about, expectations for fund managers over time. And I like this because it helps to underscore our understanding or reinforce our understanding about how well we do collectively. And you see the numbers that are important here, only 18.2 beating the market over the last shorter time frame, first half of the year. And then over a longer time frame, call it 20% or so, or 25%, but that's not even a real number. That's a different way to calculate a number, which is actually closer to 10 to 15% when you put all the years together for a particular fund that you're analyzing. So the numbers really are in that 10 to 20% range over the long term. So when you see us operating at 30 or 40 or 50% in the groundhog contest or anything else, it really is pretty phenomenal. And then this paragraph here just demonstrates how ugly basically this graph has been over the last couple of years. And then for the second quarter, it worsened again. When you have the S&P up 4% and the smaller and medium-sized companies down 5%, it's pretty gruesome. And of course, there's just the acknowledgement that that magnificent package of stocks has dominated the market's return performance over the last not just 6 months, but the last couple of years. All right, and here's some of the more. In fact, this kind of lines up a little bit with what Marie had to say. There's an article in the Wall Street Journal that talks about where have all the good stocks gone, and this one lines up with you pretty well, Ken. It shows the underperformance of the Russell 2000. Again, smaller companies in the Russell 2000. Some of them are garage sale goodies. Others are things which should be probably cast in the garbage. So sometimes it's hard to tell the difference between the two, but if you're a good garage sale person, you can perhaps find some stuff down in here, and that's what we attempt to do. And Ken, I thought this really is, because he's basically trying to figure out the reason for this beast right here, that in the middle of all this carnage, this particular fund is outperforming this nastiness here. And I don't know if you caught it, Ken, but check out, I know it's here somewhere. Okay, the difference seems to be that the index provider screens for profitability. Imagine that, Ken.
My goodness. That's almost heresy from somebody on Wall Street here. I don't know.
I just gave myself a shot to the forehead. Yeah, growth and profitability matter. And when you have a small cap that has no growth, that's not going to work out either. So the vastly superior average return for companies that happen to be making profits are a good thing. So very interesting article. And so sometimes I just did a face palm to my forehead, of course. All right, so here is a little collection of some of the smaller faster growth funds that are actually still thriving pretty well, along with some of our favorites, which have been challenged over the last few years, just like that red versus blue chart a few minutes ago. I'm specifically thinking of Brown Small Company, which has had a rough couple of years. They seem to be improving lately.
Excuse me.
But we do like like this collection of companies as a source of smaller company ideas, and I would simply point out that amongst the 20% or so of funds that have beaten the market over the last 10 years, there's still a pretty good collection of some smaller companies. I would be drawn a little bit to Oberweis. I know the Oberweises from Chicago. In fact, if Diane Grace were with us, she actually did some work directly with them out of the Chicago area many years ago. But Oberweis is a gifted small company and micro type company person, and some of the higher expected returns are here. Obviously, these are companies you want to be careful with and really be diligent about, but they've done a pretty decent job over the last 10 years and can be an interesting source of ideas. The other one that comes up in a number of our efforts is this Virtus KAR company as a potential source of ideas. These look like these tend to be a little bit larger, perhaps, but they're still out there. This is that core. The word core should be in here somewhere, but this is
Yep,
that
it
core
is.
fund. Yeah. So again, I'm going to go through these and see if there's any companies here that are propping in. This one up here, by the way, Fidelity gets a feather in their cap, but this Discovery Fund is a pretty promising source of ideas. Notice the growth rates and the quality lining up with everybody else. So it might be interesting to see if they're buying anything that is new to the screens that we run fairly traditionally. Any comments or questions?
Nope. Great list, though.
All right, so here just a quick look at another personal favorite. I am a Susan Dziubinski fan. She's one of the senior analysts over at Morningstar, and she recently came out with 33 underpriced stock picks for the third quarter and beyond. And there's some Ken Kavula favorites on here. There's some companies that have really been kind of beat up, but it's an interesting list. Your thoughts?
Well, I can't remember the last time I saw Kellogg on a list like this, so I'm a little bit taken aback by the Kellogg company being on the list.
That's
But
a fragment of Kellogg.
yeah, I know it is just a piece of it. Yeah, but there are some. I would say that if you're not studying two or three of these for potential addition to a portfolio, or if you don't hold two or three of those in a portfolio already, then you have some work to do, because I'm looking at this and I probably have 6 or 7 of them on a watch carefully list for addition to my IRAs, and I do own a couple of them on the list. So that's important, to me at least.
Yeah, I'm always fascinated by companies like VF. That's the jeans company. They actually make Levi-like pants or whatever, trousers. The other one that's really kind of fascinating is Hanesbrands, because this thing is a train wreck and could be the steal of a lifetime. This one rhymes with Ken's recent Louis Vuitton selection a little bit. Polaris.
Not quite as luxurious, but Polaris is a big watch for me right now, Mark. I've always liked this company. I've always liked their products, and they seem to be. They're not better management, because the management hasn't changed significantly, but they seem to be kind of rethinking some of their strategies, and things seem to be working for them. I'm kind of impressed by what's going on at Polaris. I know that our friend Kim is impressed with the one right above it. We've had that one added to the roundtable portfolio a number of times now.
Yeah,
So
that could be.
I keep waiting for it to go somewhere, but it hasn't. So
Incredibly high potential with that one definitely is new management, and
yeah.
And extreme competition. So it's a jungle out there for those guys, but they're very good at what they do. And Honeywell showing up is kind of interesting. That was featured by Barron's this week, and a couple other companies related to the energy industry and the Len Douglas collection also on here. So let's take a look at our view of this list. So here is the list of all 33 companies. along with the key characteristics that we look at. Again, Susan is operating largely off of the Morningstar price to fair value. So anything below 100 is capturing her attention. Probably gives her some concern when that number gets too low, a lot like an upside downside ratio of 18 if you're doing a conventional or traditional stock study. This one down here at 27 is, could it possibly be 73% on sale? I doubt it.
Mark, is this the old Vanity Fair company? Is that what VF is?
No, it's the industrial.
Isn't this Lee Wrangler? Lee jeans, Wrangler jeans?
Uh,
I might be way off base. Somebody can help me in the audience if you know, but I think this might be the old Vanity Fair Corporation. Maybe not.
Could be. I don't wear jeans, so you're out of my league, Ken. So just a weird personal quirk over the decades that I now I'm stubborn about. So good from top to bottom with respect to Morningstar price to fair value. These are ranked by the manifest rank, which is a combination of the projected return and the quality ranking. So the one at the top actually is almost within the top 1% of all companies. Schlumberger, we're going to take a closer look at, but pretty good numbers across the board here. You'll see that the projected returns are fairly consistent. The relative strength indices are not too high. Some of them are actually kind of compelling. Again, here's that Estee Lauder at below 30 and that fragment of Kellogg below 30. But again, the numbers up at the top of the chart are more consistent with respect to the value line 3 to 5 year forecast. And in this case, the analyst consensus estimates for price to fair value actually line up fairly well. They're not quite as exuberant as Morningstar, with one exception down here, and that's the vaccine company Moderna. Morningstar is very high on Moderna. The analysts on the street, the rhinos, are not. They're just the opposite. So some of that might have to do with that big negative sales downdraft following the vaccines and that. But at the top of the chart is Schlumberger. Decent sales number out here, decent return forecast. So I think we'll take a little bit closer look at that one. Some good studies up at the top of that chart. Always like it when UPS is looking favorable too. Any other questions or comments here, Ken?
No, the board is quiet at the moment.
All right, so here's a look at Schlumberger. This is a company that I think we want to consider for Buttonwood. So I'll try to make the case for it. I invested first in Schlumberger many years ago. I actually have field experience working directly with them in the industrial construction arena. Very respected company, very global. 80% of their revenues come from international sources. But they are very, very respected in the realm of energy, oil and gas production, and all kinds of equipment and services, some chemical type support, but pretty good company. They have been kind of retooling over the last few years. They did just recently do a fairly major acquisition that they are sorting through right now, but you can see pretty much up straight and parallel here over the last several years. So I had a very favorable investment with these guys personally 25 years or so ago. Left it for a while, came back, and then I gave back all of my profits, as you'll see here in this chart, somewhere along the way here. So it stings a little bit. I think, Ken, you've actually admitted that when a company disappoints you like this, you put it in the drawer and don't go back and look at it anymore.
You're right. I tend to shy away from somebody that where I got my fingers burned. I never owned this company directly, but I did own it in two different clubs that I was in, and both times we got our one time not so bad and one time pretty bad. I did my own study, and I'm happy to report, Mark, that Schlumberger, my par value comes out within 2 percentage points of your par value. So I'm feeling really good about my analysis. It at least matches Y charts, if nothing else. So
Yeah, I mean, the quality's going to fluctuate around. The company is obviously going to be driven by economic conditions and the price of the products that they facilitate. So it is going to bounce around. That's a natural thing. Um, the downdraft in the middle of the chart was a little bit concerning, but they are back at nearly multi-year highs, and that a lot of that is a result of this is a relative flat spot or a trading range over the last couple of years. But they did go up fairly dramatically post-COVID, and as Len has pointed out to us on a number of occasions, there's still a very broad need beyond gasoline, and including plastics and everything else you can think of. Petrochemicals are here to stay for the foreseeable future. So even if they make all the cars in the world EVs, there still will be demand for petrochemicals, or at least in the United States. Um, Here's just a quick look at some of the analyst conclusions. The company does have a little bit of debt, but a very attractive effective interest rate. So that basically tells you what the banks think of them. Company's trading near a 52-week low. Value Line has a double-digit return forecast, and you can see that Morningstar and the analyst consensus are at attractive levels relative to fair value. And this is the one that kind of gets me. Maybe it is time to go back with a relative strength index and a money flow index down around 30. And you can see a little bit of the description from the most recent Value Line on the lower left and the closing paragraph. I do consider us to be patient, risk-tolerant investors that are not afraid to try to capture some of that former glory. So we can continue to hope for the best. So Ken, what do you think?
well, I've always been, if I was going to go into the oil, into the energy patch to start with, I've always been, my bias has been towards companies that supply equipment rather than companies that go out and drill and explore. So I like the fact that it's unlike anything else in Buttonwood, and that it has a decent growth rate attached to it, especially for a company this large, and it has a decent par attached to it. So I'm ready to put our final cash holding into Schlumberger, and then spend the next couple of weeks looking very carefully at a couple of the stocks that maybe are not doing nearly as well as we thought they were going to when we first put them in.
Yeah, we can do a quick check to see if any of our assumptions have been invalidated. I was mentioning to Ken before we got started that Google does actually check in with the lowest return forecast. I expect that to be favorably bounce to the upside. In other words, expectations to be increased for Google with the next quarterly report when it comes in. So I wouldn't get too worried about this. And again, anytime a company has a double-digit growth rate, we give it room to run. Unless that number were negative, then we would dive in and take the return forecast negative. We would.
Mark, we're getting a comment/question from Joe. Do we know about Russian exposure for Schlumberger?
I do not. I'd be surprised if they didn't have a 5 or 10%, but I'm just throwing a number out there. 5 or 10% exposure to Russia, but we can look into that.
Okay.
Let's see if we can come up with an answer to that. I'm sure that Len will have it on my desk in the morning, so we'll do. So we'll go ahead and put that 162.50 into Schlumberger, and like Ken said, come back and take a look at the collective portfolio and literally begun managing it.
We've already promised to put Thermo Fisher on the table first and take a serious look at Thermo Fisher. I think that bears more looking at than our Alphabet does at the moment. So,
right, that growth rate, and again a relatively low return forecast, and
right, and then what you've been talking about adult beverages, Diageo might be something that we want to take a second look at as we move in the next couple 3 weeks, but we don't have to do it immediately. And I think that our approach to managing this portfolio is going to be very close to the approach that many of you take, and that's that we're not going to obsess about the portfolio. We're not going to look at it every single day, and we might not even look at it every single bull session, but
No.
we'll certainly keep an eye on it, and when something needs a little bit of tinkering, we'll try to do it. I think it's useful to understand that when you're creating a portfolio, there's probably a little bit more tinkering that you do than when you have an established portfolio. And we're just creating this from whole cloth, from nothing. So I think that sometimes the goal was to fill the portfolio with reasonable candidates, and now we'll just ask ourselves, are they reasonable enough to uphold against a challenger? And we'll try to find some challengers for some of these.
Yeah, and think continuous improvement, but not frenetic or fervent efforts to do that, but
Absolutely right.
steady long-term stuff. I mean, at some point, this company up here has to turn me back into a genius, or it'll be jettisoned. But that was 200, Ken, right after we picked it. Now it's down to 108. Yeah.
Well, we put that one in there with the idea that it was, we have two that are very speculative in this portfolio, this Vertra and this Luminar. We understand they're both very speculative. I don't know, what did we buy Luminar at, Mark?
About $1.60. Yeah,
$1.60. So we're off a little tiny bit. Okay.
Mm-hmm.
Yeah.
Not anything too bad. All right, here's your reminder that we do put all of these sessions on YouTube on under the Manifest Investing channel, and the roundtables are also accessible there if you want to take a look back at some of those sessions. And I thought you might like this one, Ken. This is Meb's quote for the day.
It's a great one. Yeah.
Isn't that something? I mean, I don't know if this goes with Hugh McManus's loathing principle. I mean, if you can find a company that really has a lot of potential going forward, but is completely loathed by the investing community, at least apparently, it becomes an opportunity. And
let's put Morgan Housel in into the minds there. We've talked about him a number of different times before on bull sessions. I don't see anything in the writing. The writing's about Mel Faber, okay?
mm-hmm.
So we've looked at Housel's books, haven't we, Mark?
Yeah, well, he has a background that extends with the Motley Fool, but he's kind of spun off, and he wrote a book on behavioral finance that we actually dug into last year, and had just an excellent reference on and very well written. He's an awesome writer. We need to pull out our book list again sometime here as
yeah, I think it's due for a dusting off. Yeah,
because I think Morgan's work definitely belongs on that recommended list also.
Well, they aren't beach books, but but they're great books to read if you're getting serious about investing. A lot of them.
Yeah, and I actually have Life. I tracked down my copy of Life After Google, and I'm going to have another run at that, along with a few Excedrin migraines as you try to read that thing. It's a great book. It just forces you to think. And this is actually it's not what you think it is, Ken. That looks like the round table, but what's actually happening here? This is a hot dog barbecue. You can actually see some of the haze coming in from the patio. So
Okay.
this is the round table nights are about to experience Portillo's hot dogs.
We got it.
All right. So with that, any other thoughts or comments, or can we call?
No, I've kept up with the question box pretty well. If you don't forget, if you have questions, Mark and my emails were at the beginning of the session, and if you want copies of the slides, send it to Mark@manifestinvesting.com, and he'll send you off a copy of the actual slides. And remember that I'm a volunteer, and for a lot of these things, Mark is as well. So give us a couple of days to answer an email. If you send it off to us, we'll try to get it answered in a timely fashion and with a little bit of thought.
So with that, we'll just say goal. And I just noticed that the Wimbledon trophy actually does say Championship of the World. So we need a trophy like that for
Okay.
the
For Portillo's, right? Okay.
Portillo's. Get out there and enjoy a hot dog for National Hot Dog Week and support my stock price. I
Good
appreciate
night,
that.
everybody.
Good night. Take care.